Welcome to Investing by the Books, a podcast by Redeye. I'm your host Eddie Palmgren, and with me in the studio is Niklas Sävås. How are you doing?
I'm great today. I had a weekend full of celebrations. My daughter turned 2, so I actually feel great to be back working again.
Yeah, that's good after releasing some new equity analyst reports last week, right?
Yeah, exactly.
Busy weeks. And today we are thrilled to talk with Daniel Zhang, an investment officer at the Swedish serial acquirer Teqnion, and the author of An Investment Thinking Toolbox, published in January 2021. Why have we chosen this book?
We think that taking a multidisciplinary approach to investing is the way to go. And while there are a lot of books on the subject, few are as practical as this one.
I definitely agree. We usually ask our guests about their most common biases and how they handle them practically. And this is what this whole book is about. So that's why I really like it. And more specifically, Daniel also writes that he hopes that the tools in the book can help us become better thinkers, better decision makers, and better investors. So that's all aligned with our thinking. And I also really like the personal approach. Like, he includes so many examples of his discussions with his partner and various investment mistakes. And so it's very, very candid. So what is an investment thinking toolbox about?
So Zhang brings up 11 mental models from the importance of having a certain competence, which is the first chapter. Then he goes on with reasoning from first principles, second level thinking, unknown unknowns, inverting, anchoring, survivorship bias, probabilistic thinking, Occam's razor, confirmation bias, and lastly, but one of the most important ones, risk, which we will get into. Daniel has a special definition of that. And the structure of the book is that he starts with an introduction to the model, and that's not always investing related, but then he goes on to present the implications for investors, his own experience from failing and prospering from using the model, as well as some practical advice.
The book is really a nice toolbox. Which is your favorite part of it?
I mean, I think, I usually read a book like this and try to take with me some practical advice. And I actually rewrote my own investing rules a bit after reading the book, which is a testament to, how good I think it is. So I don't necessarily have a specific example. I think we will get into one on anchoring with an example with Chris Sacca, which I think was unbelievable.
Yeah, I really like the unknown unknowns, but there's many good parts of this book and very well worth reading. From the framework of the quality rating, what will we focus on today?
We have the quality rating structure around people, business, and financials. And I would say this is more, of having that is more for business analysis to understand the quality of the people in the business itself, and how it shows up in the financials. But this is more on how to become a better investor, in my view. And the focus is to become a better thinker and then a better decision maker. It's always important to understand your own flaws to avoid traps.
So let's go. Here comes our conversation with Daniel Zhang about an investment thinking toolbox.
Hi Daniel, welcome to the show. It's Monday morning when we record this, and how was your weekend?
Hi, thank you very much for letting me in here. My weekend was great. I spent a lot of time thinking, actually, doing very little other activities. I felt that I've had quite a long period where I've been doing a lot based on previous thinking. So now this was a little bit of a thinking weekend, which was great. So I feel very energized and ready for a new week.
How do you do that practically?
I do quite a lot of physical activity, so some running, some time spent at the gym, and also I just spend time walking around in the forest together with my partner and talk and think about things and try to be as far away from electronics and other disturbances as possible.
Sounds like a really nice weekend.
It was indeed.
I mean, you wrote this book, An Investment Thinking Toolbox, in 2020. And
Yes.
yeah, and I was thinking it takes a lot of effort to write a book, and you managed to do it while having a full-time job and also in the middle of a global pandemic. I want to ask you, why did you decide to write the book in the first place?
I think the main reason for me was that it gave me time to think and reflect about life and investing and other things as well. And I mean, it was quite a stressful time because nobody really knew where we were heading. I mean, were we even going to survive as a human species? And how would life look like after the pandemic? But it also gave me time to think about what has happened during the last, say, decades or even millennia as a human species. And we have been through a lot. And just naming a few things such as the world wars or like the Spanish flu, the Cold War, and before that, a lot of other catastrophes as well. And somehow we have managed to pull through and survive all of that. And this gave me calm to think about the longer perspective. And I imagine people being in all of those crises felt and thought that this is going to be the end of the world. But as some very smart, wise man said once, we shall overcome. This too shall pass. So I think I've spent a lot of time reading. I love to read, as you know, and hopefully I've learned something from reading all of those things. But in the very hectic day-to-day life, I don't think that I spend enough time reflecting on what I have read have actually been incorporated into something practical and usable. So this became a time for me to actually just sit down, think about my investing life, so to say, and what I have done okay, and what I can improve more on, and just calmly look back and being as transparent and rational as I possibly could.
Yeah, it's very impressive to read how rational and calm your writing is. And how long have you been an investor, for those who don't know?
So I actually started becoming an investor when I was 18 years old. I know that a lot of investors started maybe when they were 3, 4, 5 years old. I actually didn't know what a stock was until I started studying economics when I was 18. And it was during that time where I found out about this very famous investor, Warren Buffett, who at that time already was quite an old and very well-known investor, of course. And the whole concept of being able to solve riddles, trying to learn more about the world and just satisfy the natural curiosity, and sometimes at least, if one is right, one could also make some money during that adventure, which was something that I really liked.
What did that come from, like that kind of drive?
I think the drive somehow came from, I've always liked solving riddles. I've always liked playing computer games, strategy games. I've always, maybe not always, but for some time always have liked betting as well. Just trying to solve things that were maybe not always so obvious. And investing somehow felt like the ultimate piece in that puzzle, because one could never get fully educated, and there was always more to be learned, and it was so dynamic. And I think that I've been lucky that I've always been a very curious person, and that was just a very good fit for me.
I think we will get into confirmation bias a bit later, but I mean, one thing I got back to from reading the book was that, I mean, I confirmed a lot of what I've been thinking myself, but you articulated in a much better way than I could. So going back a bit more to the book, the title of the book is An Investment Thinking Toolbox, with the subtitle being Mental Models for Better Investment Decisions. And I wanted you to, I mean, if you could tell our listeners what a mental model actually is.
For me, a mental model is kind of like a simplification of how the world works, or at least a piece of the world. I mean, the world is a very complex place, and it would be impossible to understand all the aspects, or even all the aspects within a certain field. So one could think about a mental model just like using Google Maps, like an application to show how the world looks from a point of geography in this case. And it would, for most purposes, work quite well if you want to go from A to B. But sometimes, as you probably have experienced, though, it doesn't work perfectly. Maybe the road is blocked, maybe there's construction work. And a mental model for me is quite similar, where you can take something quite complex and boil it down to something that is much more manageable, works quite often, but not always. But it's a very good, at least for me, a guiding principle for how to think about things without having the need of being Albert Einstein.
And thought leaders such as Charlie Munger, Peter Bevelin, Nassim Taleb, and Shane Parrish from the Knowledge Project have helped us all appreciate the value of using such models to improve our thinking capabilities and ultimately decision making. And I think you could make the case that there are hundreds or maybe thousands of mental models, but you managed to boil it down to 11. How did you do that?
That was indeed a very, very tricky exercise for me. I started, if I just rewind a little bit, I started out with writing down a lot or most of the painful experiences that I've had with investing, which became quite a long list. And from there, I tried to remember, based on the notes that I had, or sometimes some mental notes, on what did I not do well? What did I forget? What did I forgo? And based on that, in the next step, try to figure out, what are similarities? Are there any mental models that I should have used or didn't apply properly? So that resulted in maybe, I don't remember, but maybe 40, 50 mental models, which is far too many to actually write about, even to read about, and more importantly, I mean, that's too many to have as a rule to do any practical things with. So I kind of decided in my head that I want to have 11 chapters, just because I think a lot about risk, and chapter 11 is something I think about quite often. So I started to just, crossing off one after another, that the ones that are maybe less important, or some of them might have been quite similar, which in the end, after killing, say, 30, 40 of them, I ended up with 11. But that was a very painful process, because obviously it felt like they were all important to me, but not all were as important.
So you use the Occam's razor that you take up as one of the models to simplify, but
Yes.
not oversimplify.
Yes.
Yeah,
Exactly.
Nice. I really like the title, an investment thinking toolbox. It's not an investment toolbox, and it's not an investment guidebook or a handbook or so. It's really this toolbox, and it's a lot about thinking. And you start out the book with a concept called circle of competence,
Yep.
which you illustrate very well with this one big circle labeled what you think you know, and within that a smaller circle named what you know. And I think it's a great concept, and something you always should have in the back of your mind as you're investing. And is this something I actually know? And you bring out some good examples. But it's also very hard to be sure, like, what do I actually know? And that is not something that I think I know. So what's your view on the boundaries of circle of competence?
I mean, the boundaries are really tricky bastards. Am I allowed to say that?
Yes.
Yeah, great. I mean, it's easy to see what things are far outside. For me, there would be pharma companies, biotech, high-tech software programming, etc. That's easy for me to understand that it's far away. But the blurred line is kind of like a disco light almost. It's pulsating and it's moving, and it's depending on, among other things, like my self-confidence, which is obviously bad. So sometimes when I'm in a good mood, or when I've done some investments that have played out very well, and the line kind of moves outwards, and the opposite can happen in the other direction. So the boundary is just so tricky to nail down where it is. And I made a mistake so many times of thinking that it was within my boundary, where it actually wasn't. So I think one answer to the boundary question, which might or might not be helpful, is to, if one needs to think about if this is or is not within the boundary, just let it go and choose something that you know for sure is within. That has been a guiding principle that has been helping me quite a lot.
Yeah, that's good advice, to invert it that way. But the hard part is when you're, like, as you say, you're a curious person. So you want to know things, you want to learn about new topics, and you're always interested.
Yeah.
So do you like actively try to limit yourself from that?
Yeah, I actually try to do that a little bit. It is quite boring, and there are a number of companies, say 50 or so, that I've been following for quite a long time, many years, and where I have notes that prove that I have at least put some thought into them, and sometimes have been more right than wrong. And those I try to keep and keep myself updated regarding. And as you say, I am quite curious. So every now and then, every day almost, I would say, I find something new, a new company or a company that I haven't thought about for a while, and try to learn something more about it. And naturally, I try to not do anything with these companies because I know that I'm a novice, I'm an amateur when it comes to the knowledge and the valuation of them. But I have a belief that sooner or later, maybe after some years, maybe after a decade, maybe for never, some of them might move into the circle of competence within the boundaries. But I absolutely do not stress that in any way.
It's probably good to be cautious when you're going that way. So another chapter that I really like is the unknown unknowns, and that is very related to the knowledge about what we know and what we don't know. So for those who don't know, what is unknown unknowns?
Unknown unknowns are a very interesting concept. It's kind of like the bottom part of an iceberg. Quite often, I feel at least, that there are things that just seem so easy that I figured out what the direction will be. I understand the dynamics is something that I quite often feel. And the tricky thing here is that too often when I feel that, it's just because that I do not understand it enough. I do not understand the different complexities, and therefore it sounds so easy. And those things that I do not know are the unknown unknowns. Things that I don't know and that I didn't even know that I didn't know. That's tricky to say, but it's something that you see in everyday life quite often. When you see different professions try to tell other professions how to do their job, as an example. I guess everyone can relate to that. Like everyone probably has thoughts about how should the police do their job better, or how should the school and teachers do their work better. And sometimes it feels crystal clear, and sometimes you might be right. But quite often in those cases I feel that it's probably because one does not understand the complexities that lie behind it. So that's the long explanation for how I think about the unknown unknowns.
Yeah, I think you write very well in the book also with the example of when you face something that is unknown to you, you might think you know more than you do.
Yeah.
And then you're at risk of that. And the other, like on the other side of unknown unknowns is known knowns, just to contrast a bit. So people understand that is basically facts that you know for sure that I know.
Yes.
And then you also have two other parts in that model which are unknown knowns and known unknowns. Maybe go into shortly about what that is.
Yeah, so I guess it becomes a little bit easier if you have the picture in front of you. But
in the book is very well.
So when it comes to known unknowns, those are things that you actually know that you have no clue about. For example, there might be companies such as Netflix, where subscriber growth is very important, and most probably you do not know the exact number what it's going to be in the next quarter or the next year. So that's a known unknown. The fourth quadrant in this matrix is something that I call unknown knowns, or what you could also call implicit knowledge. It's things that you actually know about, but that you haven't really been able to articulate. Sometimes it can be important knowledge, and in those cases, it's interesting to find different ways to ask questions. You can bring that up to the surface of your attention, so you can factor it in the valuation. And sometimes it's just maybe not as important. Maybe you know the taste of a McDonald's hamburger. That could be implicit knowledge, but maybe that doesn't really matter into the valuation. So that's the four quadrants that I try to think about. And out of those four, obviously you would like to have as much as possible that makes sense into the known knowns. It's important, obviously, to know, I feel, what you do not know. So you can try to look for those answers, or maybe walk away because it's too difficult. But the quadrant of unknown unknowns, that is very tricky because you, per definition, don't know how big it is and how important it can be for the case.
Yeah, so you try to go deeper into things and you try to move things from unknown unknowns to at least questions in the other quadrants, or to something that is actually knowledgeable.
Yeah.
And how do you use that, like, practically when you're investing? Do you have some example?
Yeah, so I mean, one quite good tell for me is that if I feel that it's very simple and I have a very simple narrative and a simple case for it that is straightforward, it probably means that I have too much into the unknown area, because very few things are that simple. But apart from that, I try to read different reports about the company. I try to read the company's own material, like quarterly reports and annual reports. And I try to talk with people that I respect and know that they know something about the company. And if from all these three sources, as an example, I kind of know everything that are of importance from the discussions and readings, it can be a tell, at least, not a certainty, but a tell that the unknown quadrant is relatively small and that I have a handle of it. But if in those discussions I get a lot of aha moments or surprises and questions that I haven't thought about, that's a very good tell that there is a big quadrant of unknowns, and that I should be very, very careful with going forward with the investment.
Yeah, it's always good to talk with people, and this comes back to circle of competence, really.
Yeah.
Yeah, and I think you're really I mean, with your examples you have in each chapter, I think you have a great example here where I think you frame it as a mistake that you put too much effort into something that turned out to be, there turned out to be too many unknown unknowns, but at least you didn't make two mistakes that are quite common.
Yeah.
you didn't invest, at least.
Exactly.
I think that's a great thing to take with you, because that's something you take up in the chapter on confirmation bias, that if you put too much effort into something, then you actually want to believe that it's true. Anchoring is one of the models that is often brought up as one of the most important ones for investors, and I think this really hit me on the head when you brought it up. a normal problem for me, and I think for other investors, has been that, I mean, you decide like, okay, I want to buy this stock at price 40, and then it goes down to 41, and you're still, I mean, I don't want to buy until it's 40, and then you miss out, and then you have a 5-bagger in 3 years, and yeah, you really blew it. And I think the example you bring up with Chris Sacca, the investor in Uber, who actually invested, and then 15 months later he invested at a 64x valuation. So I mean, that's a big lesson for many of us, I think. Can you maybe describe that situation a bit?
Yeah, I mean, Chris Sacca is really a living legend within the field, I think. He's more of a venture investor, where he has been very, very successful in finding picks as Uber and Twitter and many more. So I think he was one of the first investors in Uber, where they basically didn't have much at all. They didn't have a product. They had basically a PowerPoint and maybe something else, where he invested in a valuation. And because he believed in the team and that there would be a good product market fit. Obviously, I don't know exactly what his thought process was, but I'm guessing it's along those lines. And only a few months later, it seemed like the team was progressing, and Uber guys needed a new investment, but at a much higher valuation. So he decided to invest there again, not regarding that he actually paid maybe 10% of the price or so in his first investment. And he actually participated even in the third round, as you said, at a 64x compared to his first valuation, where he still felt that the progress has been so good and the upside would still be tremendously high. So disregarding that he paid basically 1-2% of his valuation, he still felt it's worth putting more money here at work. And that is so impressive. I cannot stress how difficult that has to be. I don't even know if I have had I've had one, I think, 100-bagger, but I mean, just thinking about investing at a point where you actually paid 64 times less makes my head ache.
It's like a reversed sunk cost fallacy.
Yeah, exactly. I think that has to be one of the most difficult things there is, because humans, I think, overall are so bound to anchoring and what we think is normacy and a normal world.
I must ask you, on that 100-bagger you mentioned you had, did you buy, did you average up in that position?
No. In that situation, I was very, very lucky in one sense. Timing wise, I never think about timing, but I think that the stock actually went up quite soon after a couple of months, maybe 3 months after my initial investment. I had a thought that I would put some more money to use there if the stock was going to be still at those levels. But when it started to go up, if I remember correctly, it kind of went up overnight. So there wasn't much possibility of putting any more money at work there.
Too bad.
Yeah, because that's, I mean, typically what I wanted to get to is that's typically the biggest mistakes you can do, to not average up in such a position.
Yeah.
We talk a lot about mistakes of commission, but not so much about omission, which is maybe.
No, and in that specific case, I mean, I'm very happy that I found the case. I think it was very intellectual stimulating for me to do the case and do the analysis. But it is also one of my biggest mistakes, because I think that the analysis and the process was kind of okay, at least. It held as a case, but I didn't employ any significant amount of money. We're talking about 0.something% of the portfolio in a case where I actually believed in 100-bagger. And that is really not smart, to put it lightly.
Do you know, by the way, with Chris Sacca, do you know if he increased his ownership when he did those new investments on higher levels?
He actually did. So he took more than his actual percentage stake.
Yeah, because that's otherwise I could see that, okay, he's just trying to keep his ownership at the same level. So that's why he keeps investing with a kind of confirmation bias in that way. But, well, that makes it even more impressive.
Yeah, definitely. Another one that you bring up is survivorship bias. And I think here you actually bring up a question to the readers, which I think is really, really helpful. I mean, survivorship bias, in short, just means our tendency to overvalue lessons from the survivors. As, I mean, history is usually written by the winners. And, of course, there's a lot of luck in certain situations. It's so even though the winner only had a 10% probability at the start, he or she turned out the winner, and we try to learn a lot from that situation, even though maybe luck was the most important thing. And the question you bring up is how much of the conclusions from the survivors are sensible to use. And I wanted to ask you if you have thought more on that after you wrote the book.
Yeah, I think about that quite often, actually, and I still don't have an answer, obviously. Maybe I have some bits and pieces. I think it's so difficult because you see on a daily basis that, company X, Y, or Z is the Amazon of, or Netflix of, or Apple of something, just because they have some characteristics that maybe resemble the said companies. What I try to do is that I really try to break down what a relationship is, and when it comes to survivorship bias, is it a statistical fluke, or is it something that has a real scientific or statistical backing combined with a story, let's call it a story, that actually makes sense. Sometimes the numbers could tell a story, and it's very simple, as we human beings love stories, to tell a story that kind of sound like it makes sense. But very few of the stories that I feel that you can read about in the financial media like CNBC, etc., have some real backing. So there are a couple of things that I think, or at least I hope, stand true. And for example, you could probably find a lot of survivorship bias in this as well, but like the good culture where individuals can grow, that is something that overall creates value, everything equal. Decentralization and employees taking ownership, transparency, agility, business models that create value for customers, value and price that they will converge, for example. And there are some things in this area where I choose that I believe in based on hopefully facts, at least things that I think are facts, and has a story that I personally believe in, that I try to apply so that I can get a better way of thinking about things. And I think it's a little bit like the circle of competence, because there's so much noise on other things that could work and have worked for certain companies. But I think I try to remind myself as often as I can that just because it has worked once or twice, and just because it worked at this specific time with those regulations in that country, doesn't mean in any way that it can be replicated in another part of the world 2 decades later.
Yeah, I thought a lot when I read this chapter. I thought about what Jeff Bezos had, his 3 pillars on how to create a great e-commerce business with Amazon, and he focused on, okay, what will stand the test of time. Consumers would always want a large assortment, low prices, and good convenience. And then, I mean, he managed to put most of the effort into those 3 pillars, and I think that's one of those you can find that actually has worked really well.
Yeah.
But of course, it's hard to see that in the beginning because there are so many other variables that you need to think about. But
Yeah, exactly. And I mean, the times change, people change, and technology change, regulations change. And maybe another example that I think I've thought about a lot and also made a mistake to think about the replicability too much is like Berkshire Hathaway. The way Warren Buffett built Berkshire Hathaway and using the insurance companies with float and how great that business model has been. And obviously that is some survivorship bias in that because in today's world where you have more regulation, where you cannot put as much of the float into equities, where the interest rate on money is basically zero or sometimes even negative, the float doesn't even contribute. It could actually be of negative value. And there are other things that have changed as well. And I think it's important to just think about really hard that just because it was good or even great or superb at one time, with the Berkshire Hathaway example or the Amazon example, doesn't mean that it's always like that.
so in a way, I mean, you can also relate to human beings, why humans have been so successful. And at least I believe that, I mean, how flexible we are. I mean, we can fit in almost every environment. We can change with new circumstances quite quickly. Maybe that's one of them I like to think about.
So maybe a devil's advocate here on this side, but a thought that often pops up in my head, and maybe it's because of my concerns for the environment and that situation, but I'm thinking how everyone is always so certain that the stock market will be higher in the long-term perspective, and simply because there will be more people and GDP will keep growing, and then you read in Hawking's book that in 500 years people will stand next to each other on all surface of this planet and no one can ever move. So it's like if we keep growing at the current rate. And you also write this in the book that, like, without hesitation really, that the market will keep going up in the long run. In the short term it's also of course uncertain, but and I understand it's likely, and maybe it's not really helpful to think like otherwise. You mentioned in the beginning about World War II and the humanity has been overcoming everything. But isn't there, like, when we look at these biases, like survivorship bias, confirmation bias, anchoring, all of these are really like justifying all the kind of convictions and what has become truths of the stock market, that 7 to 10% yearly returns and P ratio of 15 over, like, because if we look at the market in over 200 years, it's a long time period, of course, for us, but it's insanely short for humanity and universe to draw any conclusions. It's a big picture question, but do you have some thoughts on that?
Yeah, that's a great question. And I mean, it's big and difficult, and obviously I'm not smart enough to have any kind of answer on that. I have, however, put quite a lot of thought into it without coming to a conclusion. Other than that, and this is really survivorship bias at play, as you say. I mean, looking at the rather short history of the stock market, the financial market, and even humanity, things have been going in the, I have to be careful what to say here, but things have been going in the direction of less poor people and more welfare. And obviously there are other things that have gone maybe in the other direction. You mentioned environment, maybe risk of nuclear war has obviously increased over the last 200 years. And this is maybe where my rationality ends and where almost a spiritual, or let's say a religious part comes in, where I absolutely have no clue if those systemic risks like the climate change, etc., will put a collapse to all of the progress that we have had. I mean, the risk is there. I have no clue how big that risk, or even the other, let's call them black swans events, could be. But the system that we have in place with capitalism together with a free market and democracy has shown to work pretty well over the last decades, even if that could be a lot of survivorship bias here. But what I kind of have chosen, because I really can't figure out a good answer on it, is that I've just chosen to believe that we will together let capital flow to where it is needed in order to also solve these systemic risks, or at least maybe postpone them for eternity, or at least long enough until someone smarter in another generation can solve it. And if I'm right, hopefully that means that the stock market and welfare overall will be going up over time. And if I'm wrong, I guess that the value of my portfolio is probably the least of my worries, and I don't need to think about that or care about that anyway.
That's a good answer to a tough question. I think in the same terms, and I guess it comes down to risk aversion, basically. How much do you want to keep in assets that are more sustainable in a way for yourself for the long term?
Going back to the concept of confirmation bias, which is arguably another one that's hugely important. And I think you had a really good perspective on that. You mentioned the 7 sins of confirmation bias, and I want you to tell us a little bit about them.
Yeah. So confirmation bias is very tricky, I think, because people, human beings have been developed through evolution to be in groups. It's scary to be alone, and therefore it's nice to be confirmed. And confirmation bias becomes important because we have some kind of DNA programmed part of our brains that wants to be confirmed. And when it comes to investing, it doesn't really help that other people confirm what you think is true. So the framework with the 7 deadly sins is basically the process from start to end, where you start with search, where one actively looks for data and information in order to confirm one's initial view, which obviously can lead to very bad decisions. Secondly, you would have preference. So even if contradicting evidence is found and exists, we tend to prefer the evidence that supports our initial belief, so that you don't have this cognitive dissonance. Thirdly, you have the recollection part, where somehow it's actually easier to remember the information that supports one's initial belief. It's easier to forget arguments and facts that doesn't support it. Fourthly, you would have interpretation. So even if I'm presented with the same set of data as maybe you two, we would interpret it differently. I would probably interpret a little bit closer to what I believe in order to confirm what I believe in. And it's not because I want that, it just happens naturally. And you would interpret in a different way, a little bit at least. Then you have framing. So you could be using mistaken beliefs to misunderstand what's actually happening in a situation, which is a little bit different to interpretation, but still quite similar. Discarding is the 6th sin here, which is about that you explain away or discrediting information that actually does not fit with the belief. So even if you are presented fact, you might think that it's not a fact. It's fake news, as a famous guy likes to say. And the last one is testing. This is something that I struggle with quite often. So it's kind of like the ostrich putting the head into the sand. So when maybe there's a little part of you thinking that maybe I'm actually not right here. Maybe I should look up some more facts. Maybe I should run this analysis again. There's a much more powerful part of the brain saying, no, let's not do that, because if you do that, there's a risk that you're wrong. So just don't take a look at it again. So when it comes to investing, the important part over time, at least, is to have a good output and being right in the analysis, which hopefully leads to a good output. So even if one would fall victim for the deadly sins over time, it probably means that one has less cognitive dissonance and maybe feels better about one's decisions on a day-to-day basis by not challenging them. But I am a strong believer in that would result in worse results over time.
Yeah, and I think what the point with the 7 sins really brings home is that it's really dangerous in all aspects of the process of thinking and of course for investing. How did you come up with this list?
I think it becomes quite easy if you make as many mistakes as I do. And when I thought about the list of mistakes that I did, it became quite obvious for me that I didn't make one mistake when it came to confirmation bias during one part of the process, but rather I felt like the ostrich with the head in the sand from beginning to the end. And I felt that during the analysis, there were so many pieces in the process where I should have done differently, but I really wanted to be right. I really wanted the fact or people to confirm that I was right. And by breaking that down, I came up with the 7, let's call it the 7-step process or the 7 deadly sins, where I could have had checkpoints somehow that would help me at least partly out of my problems.
And you mentioned that confirmation bias is the most dangerous of all, but I don't want to put you, on the spot there, because maybe you have changed your mind. So do you still believe it's the dangerous one, and why?
I actually still believe that. And the reason I believe that is that, at least for me, the other mental models that I have written about in a book are kind of one-off decisions. Circle of competence as an example. You kind of just need to decide, is this something that is within or outside the boundaries of my circle of competence? And if after that decision, you can just move along based on what decision you took. When it comes to confirmation bias and the process and the 7 deadly sins, as you heard me talk about the list, it's really with you from the beginning to the end. So you can't take one decision. You have to kind of guard yourself against it all the time during the whole investment process, which could extend from first finding information before you invest, which could be years before the investment. And if you are a long-term shareholder and own the stock for many years, that's something that you need to live with and guard yourself against, maybe for years or decades, all the time, which is something that I think is difficult. And also, it really goes against human nature. Once again, circle of competence, it's relatively easier to agree if it's inside or outside. But confirmation bias is really that the best investors, I believe, are people that challenge themselves all the time and in the belief that they have. And this is very inhumane almost, because we like to be confirmed. We like that to feel at ease. And having a holding in a company and all the time asking yourself the question, is this the right decision, is really difficult.
Doesn't it come down to emotions, actually?
Yes, I think that has a lot to do with it.
Yeah, and we know many successful investors who are not very emotional people, and they can kind of keep it separate from themselves.
Exactly.
Very interesting.
Yeah, and another aspect of it is, as with a lot of tools and thoughts, it's mostly a negative, but it's in one way could be a positive to hold your conviction to really hold the 100 bagger over time. I know Munger says about marriage to keep your eyes wide open before marriage and half shut afterwards, which is a reference to that. But as you mentioned, I mean, how do you balance the sort of the good parts of it, of keeping your conviction with falling in the trap?
That's really a great question. And when I've figured out how to get a few hundred baggers, I can maybe come back and tell you the answer. But I try to think as Munger, because he's obviously a very smart person. And as you said, one of his strengths is probably that he's so rational and are able to really control the feelings and put the feelings as something inferior to the logic, which is very difficult. Obviously, you want your team to win. So there's a lot of confirmation bias playing in all the time. But I try to read opinions from the other side. I try to discuss with people sometime that I know or think that they know a lot about the companies. I try to remove emotions from the cases as often as possible. So, for example, we have an ironclad rule that says that after finding a case and deciding that we want to buy it, we are not able to buy it within a month, because after that, maybe some emotions will fade away. But once per year at least, we try to think about the companies that I have in my listed portfolio and just really challenge that holding. Should I sell or should I buy? And there's no hold in my way of thinking. But I only do that once per year because maybe, I hope it's because the quote of Charlie Munger there, but it's also a lot because it's really painful to look at your own team and holdings with such scrutiny more often, at least for me.
Right, and we're really moving into your current work position at Teqnion, where you are an investment officer, and Teqnion is a Swedish serial acquirer. So first of all, what is that, for those who don't know, serial acquirer concept?
So that's something that's quite special in Sweden, I believe. But basically, I think there are four characteristics that would give a good tell of if it's a serial acquirer or not. One is that the primary source of growth is through acquisition rather than organic growth. Secondly, the acquisitions are relatively many, but small in size and of unlisted private companies. They focus on rather stable companies that are profitable rather than going into venture capital or turnarounds. And fourthly, I think a common thread is that they tend to have a eternal holding period, i.e. not selling the companies after a holding period of, say, 5-7 years, as private equity companies usually do.
Yeah, truly a buy and hold strategy.
Yes.
And what about Teqnion? What kind of company is that?
So Teqnion is a serial acquirer as well. And I think what is very different with us, obviously I haven't worked with any of the others, so this is kind of an outside view as well. But there has been quite a lot of popular, let's call it popular rhetoric regarding how companies should be run. It has been very popular to talk about decentralization, full ownership, flexibility, agility, etc. And I think for some companies they're doing this really well and they really walk the talk. And I would say that Teqnion absolutely is one of those where these are not pretty words on the wall, but it's something that we truly value and do at an extreme almost. And I think there are maybe two things that I think keeps us apart from the rest. One is the culture that I've been talking a little bit about, where we really value and treasure entrepreneurship and true decentralization, and we have a uncompromisable focus on individuals. We are not at all interested in growing a big forest. We are kind of arborists that pick out and cultivate the greatest oak, the finest maple, the greatest pine, etc. And that focus on individuals also mean that we kind of know the name of all, say, 350 people in the organization, and we have a culture that make people feel included, and especially the new entrepreneurs that have been selling their companies, they tend to forget even that they have sold their companies, and they keep working in the same way as before, but now they have more friends. Secondly, what we try to do at Teqnion is that we act with great discipline when it comes to capital allocation. We are really relentless on that. I think we also have the highest cash adjusted return on equity among all the serial acquirers.
In Sweden?
In Sweden, yes. Thanks. We do not compromise at all on what we pay and thereby the return on equity based on growth. But that also means that in times where there is a lot of capital, there's an abundance of capital right now, we might not be the company that are growing the fastest or buying the most amount of companies, but rather being very, very disciplined with the capital that we have.
And what is that valuation approach?
So we have a valuation approach that basically stems out from a discounted cash flow, but with some adjustments. So very simplistically, we try to get back our money on a cash basis within 5 years. That's basically the valuation approach that we have had since the founding of Teqnion in 2006, and we've kept that until now, and will continue to forever.
Right. And how do you work with the acquisitions? Are you processing in auctions, or how do you do that?
Yeah. So Teqnion has had a history of sometimes participating in auctions. Buying unlisted companies have sometimes been quite unsexy, where there have been very few potential buyers, and in those cases, in those times, we have been participating in some processes. But right now, where the interest have gone up a lot, we have chosen to remove ourselves from all kind of structured processes, because one, obviously, in those processes, you get the winner's curse, i.e. you pay top dollar, the most money out of all potential buyers in order to get the company. But more importantly, actually, it's not only about the money per se. We want entrepreneurs to join us because they and we together believe that we are the best fit for their companies. And I mean, to be clear, we are absolutely not the best home for all kind of unlisted companies or for all personality types, but we want to find that match. And those that only want to get the highest amount of dollar amount for their company, I mean, I understand that perfectly, but that is not the kind of culture and individuals that would be a perfect fit with Teqnion. So nowadays we actually only do our own approaching of companies, where we find and search for companies that we believe have a good future, and we call them and ask if they would like to be part of our Teqnion family. And sometimes they say yes.
From reading your annual reports and also your quarterly reports, I can see that you clone what Warren Buffett did of making public that you want entrepreneurs to call you with prospects.
Yep.
Has that paid off so far?
Actually, it has. I mean, right now we haven't closed any deal based on those free ads, but we have gotten a few cases, both from entrepreneurs that have read it and thought it was interesting, and where Johan and I have been visiting a few of them.
Johan is the CEO, right?
Yes, thank you.
Johan
The
Stene.
founder and CEO. But we have also received a few cases from people that have been investing in Teqnion, maybe just a few shares, some of them a little bit more, that feel and are rooting for their home team. And I mean, what better way is it to help yourself win by helping your team to recruit new entrepreneurs? I mean, this will most likely within the near future never be our biggest inflow of great cases, but it's free and it's fun and it has generated something, so we'll probably keep doing that.
It's funny that you bring that up, because that's exactly how I think some deals Buffett have done has been through their own investors who have, I mean, looked at their networks. So it seems to work well, but you have to be a certain type of company for that to work, I think.
Yeah.
Just going back to, I mean, you've been at Teqnion for a while, but not for too long. When did you join the company, and how do you spend a typical day?
So I joined the company at the beginning of the year, so I'm fast approaching the 1 year milestone. And time really flies fast when you have fun, and we have so much fun. I think I have the best job in the world. No disrespect to you, but I think I have a little bit more fun. I mean, the boring answer is that there is no typical day, and I'm a person that probably have a lot of letter combinations as diagnosis, so I would never be able to live in a situation where there would be very structured typical days. But I think there are maybe two types of days. One type of day is a home day, where I run to the office in the morning, maybe at 6:30 or so, and try to look and think and discuss companies with my great colleagues, and try to contact new potential sellers, write indications, valuations, keep the ongoing processes with due diligence, etc., ongoing, and maybe support our current companies with some business development work. So it can be really everything, but mostly focused on the acquisition pipeline, so to say. And we have always different companies in different stages, so that will make the days look very different. And then I probably run home and leave office before 6 and reflect about the day. The other kind of day or group of day that I have is that maybe, let's say, twice a week, I usually run to the train station together with Johan, the CEO, and we either take the train or Arlanda Express to take a flight to meet potential sellers at their home turf in order to learn more about them, their journey, and what has made them and the company so successful. And obviously also very transparently telling them who we are and why it could be interesting to be part of our family. And those are, I think, the most fun days, because there's so many great companies here in Sweden that you have never ever thought about or even thought could exist. That really is the backbone and makes the society work behind all of these big companies that you kind of see in the news on an everyday basis.
I guess the second type of day is a bit more rare than the first one, or?
I think the second type of day is maybe, I would say on average maybe twice a week. So we meet quite a lot of different companies, but as I said before, we are very disciplined when it comes to valuation. So obviously not all meetings lead to an actual deal. And we also approach these companies ourselves. So it's not like these entrepreneurs have been thinking too much about selling, and they sometimes are not ready, or I would say most of the times they are not ready to sell now. But starting up that process is obviously the first step in a potential acquisition. And I mean, Johan, as a ultra runner, is famous for being very, very long-term focused, and that has really shown in the Teqnion culture as well, where I think our record is that we acquired a company last year, a great company called Injab, where the first meeting until the deal closed took around 9 years. So some of the traveling we're doing now probably would bear fruit in the years to come, while sometimes it can be really quick, where everything and all the stars are aligned. It could maybe just take 3-4 weeks, but we are in no hurry. Long answer to your question, but maybe
it was a good answer. I mean, and it really, I mean, it's a lot about delayed gratification. So you don't need to expect a payout early.
But you always try to meet the companies in person?
Absolutely.
Yeah, and see their production or so on?
Yeah, so for us, because we focus so much on the individuals and culture, we do not use consultants. We try to keep lawyer firms away whenever possible. And so it's really a dealing between, it's really a mano a mano, as you would say, where we try to sit down with the person and be naked in a maybe literal sense, and so we can show each other where we stand and what we think about, and the focus is really on the qualitative aspects. Obviously we do the due diligence on the financial side as well, but that is more as an insurance that everything is as we thought, and is very secondary to the feeling we get from the individuals and the culture. When we walk around there in production, are people smiling? Do they feel that they belong to a group? Those are things that we really look for and treasure in our acquisitions.
I wanted to ask you if the toolbox have already helped you in buying private companies. I mean, you wrote the book as a public investor, but now you have the chance to use it as a private investor, so to speak, of buying private companies.
Yeah. So I hope so, is my answer, I guess. I try to flicker through my book, especially the bullets in the end of each chapter, which are reminders to myself how to not make the same mistakes, so it doesn't become a paper product. So risk is probably something that I use quite a lot in my job today. Risk can be defined probably in hundreds of ways. And
yeah, it was one of the questions I really wanted to ask you, and it's good that you bring it up. If I can just say, I mean, I would say that the normal ways is either you measure it with volatility,
yeah,
or you measure it with, I mean, many value investors I've heard have said that it's probability of losing money or risk of losing money. And you have a third definition, which is more subjective than the other two.
Yeah, exactly. So in my world, for me, there has to be an aim or a goal in order to be for a risk to exist. So if my aim is to, for example, run a 10K race under 40 minutes, the risk is not. So the risk would be to not be able to do that. So the risk is always in relation to something. And at Teqnion, for example, we have different financial goals, and I think the most important one is that we will try to double our earnings per share over a very long period, but we will do it on average every 5 years or so, and which means that in 50 years or so we will do 1,000-fold. So that's the risk I try to think about, and in acquiring companies, instead of thinking about fluctuations, there are some unlisted companies, private companies, as well as listed companies that have a lot of fluctuation in their financials from quarter to quarter or maybe year over year. And overall fluctuation is something that is not loved by the investor community. People overall like a smooth journey, but because we are a serial acquirer, all of the companies that we acquire would become a very essential part, an important part of the whole group, but none of them would be big enough to be able to make or break the group. So risk, for example, here is very interesting. So I love companies that have certain fluctuation because other investors do not like to buy them. Prices overall are a bit lower, but as long as the risks, or actually the fluctuations here, are not correlated with the other companies that we have, it doesn't really matter for us if we have a number of companies that fluctuate quarter to quarter.
Yeah, as long as they come back.
As long as they come back, and as long as they are uncorrelated, it also only means that we get them at a lower price. And I also think that in a lot of cases, the fluctuations are more on an accounting side than on a fundamental side, which I think is quite important to also think about the difference there.
Yeah, definitely. And maybe it's more about uncertainty than actual risk.
Exactly.
Yeah. And something I thought about is that you mentioned these kind of simplified ways of thinking. You really try to make it easy, like with how to get your money back in 5 years. But then on the other hand, in the book, you mentioned that you do DCFs and you do the Monte Carlo analysis, and which are really like quite heavy valuation tools. Like, how much do you use those kind of help in your work? I mean,
yeah. So in my work, I absolutely do DCFs. We have a little bit of different spin in it because risk, or actually the risk-adjusted discount rate would be a little bit different in our world compared to as one would think maybe when purchasing listed companies. But basically we use DCFs and value companies and try to figure out a price that would equal getting back our free cash flow on a 5-year basis. So that's kind of the ironclad rule that we use for valuation and using DCFs there. Monte Carlo is not something that I or we use in looking at private acquisitions. I think Monte Carlos are a great tool for certain aspects, and it's great when there's a lot of uncertainty that I think is very difficult to know about. Like, it's very difficult to know if the growth rate is going to be 2, 3, 4, or 6%. Maybe it's very difficult to know if the margins are going to be 6, 8, 10, or 12%. And I think Monte Carlo is better used for companies where one has less control, typically a listed company. But for us, because we actually acquire 100% of the company, we know the people, we actually know the business plan, we know or think that we know what we can control. The Monte Carlo becomes a tool that wouldn't be as relevant because, like the margin, for example, we would in most cases be able to actually almost choose the margin based on pricing and cost. Obviously, it's not that easy, but it is something that we very clearly can influence, and therefore Monte Carlo wouldn't make as much sense because it's more built for things that you cannot control, in my opinion.
So actually, when you see the situation where, oh, here it would be good to use the Monte Carlo analysis, then you should avoid it.
Yeah, exactly.
That's a good way to use it.
Very good put.
Yeah.
So Daniel, this has been a fascinating discussion, and we really look forward to see if Teqnion can deliver the 1000x that you mentioned over the really long term.
I hope so too.
Yeah, it would be a great story. We, of course, being a book podcast, we are always interested to hear which books you are reading right now, and what maybe we can start with the books that have been the main inspiration for you.
There's 3 authors that have been very important to me, both maybe in the investing career, but maybe even more importantly, like living my life outside of investing. So the first one would be Warren Buffett's annual letters to shareholders. It's not really a book, but I think if you put them together, it would be quite a thick book. I think that those letters together are better than any MBA in the world, where he explains very well his approach to capital allocation, leadership, and much other things that I think are very important. Secondly, there's this guy called Nassim Taleb, who has written quite a lot of books about risk, among others, but a lot about challenging conventional wisdom and be more independent as a thinker. And those books, I think, are well worth a read. And thirdly, it's actually a fictional book, which is called Before the Coffee Gets Cold, written by a guy called Toshikazu Kawaguchi, or however that is pronounced, which is a very philosophical book about how to live a happier life. If there's anything that I think is more important than investing, it's probably how to be happy in life. So that's a recommendation from my side.
And is there any book that you would like to exist?
I would love if there was a book, maybe there is, a book about good books with practical advices. So kind of like index of good books. There are so many books out there, and I think a lot of them are good, but it would be just so great if someone could just summarize the ones that actually work with practical advices.
In a certain topic?
Investing would be great.
Right.
Becoming happy is also nice.
True. Investing by the Books has done a bit of that work, but maybe there's someone to compile a big index like that. And for yourself, do you want to write another book with the rest of the mental models you didn't fit in this one?
I think for now I'm quite happy with the writing part. Maybe one day when we feel that Teqnion can look back on a 50-year journey and has made maybe 1000x or more, it will be fun to write about that journey.
Great, look forward to that. And before we finish up, do you have something more you want to add?
I think that you guys are doing a really good job, and I think I'm really honored to be part of your podcast, and I've learned a lot from all the guests that you have brought here. So well done.
Thanks. That's great. And for those who want to buy the book, An Investment Thinking Toolbox, where can they find it?
So in Sweden, you can find them at Adlibris, Bokus, Akademikbokhandeln, and the other bookstores. I think it should be able to be bought at Amazon as well.
Good. And for those who want to follow you, how can they do that?
I'm not so public on the social media space, but you can probably find me on LinkedIn. Or otherwise, I think following Teqnion would be indirectly following me as well.
Thank you so much, Daniel. This has been great.
Thank you.
Thank you for listening to Investing by the Books, a podcast by Redeye. You can follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve the podcast, we really appreciate your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For a full disclaimer, visit redeye.sc. For the sound engineering of this podcast, we thank Gustav Tesch, and for this editing, Carl Bergholtz. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.